Hello, everybody. Sorry we're a little late this evening. We just had some minor technical difficulties. So this evening, this is our third broadcast of this year. And tonight we're going to talk about guaranteed income contracts. And joining me this evening is Dave Thomas, who's the Regional Sales Director with Desjardins. Thank you, David, for joining us this evening.
Thank you for having me.
You're welcome. So just some minor housekeeping just to keep in mind. So first things first, you should notice on your screen, I believe it's just below the video, and if not, it'll be to the right of it, there is a Q&A section. So if you do have some questions as it relates to our presentation this evening, you can go ahead and submit your questions through the Q&A, and we will address those questions at the end of the presentation. Secondly, this broadcast is recorded live. However, it's under PVR mode, so if you do have to step away from your computer, tablet, or telephone, phone, you have the ability to press pause, step away, come back, and if you hit play, it'll just continue on from where you left off. And finally, we are going to be recording this broadcast, so we will be uploading it to our YouTube channel and distributing it to our clients. So once again, David, thank you very much. And tonight we're going to talk about how we can protect your retirement income using Helios2, a product that's offered through Desjardins.
Thank you again for having me, and I'm looking forward to having this discussion with everybody. Like Jim said, there is Q&A, and for some reason, if I don't have the answer, I can always get it for Jim. But let's start off with the first slide. So in 2012, Desjardins came up with a survey, and basically what we were looking to do is find out what clients are feeling going into their retirement. And there was a few questions that were asked, and the ones that I put up here are the ones that got very interesting answers. The age group between 55 and 65 going into retirement or close to retirement, 76% of those investors are extremely worried about the volatility with investing. And more importantly, what we found was that when it came to women and men, women felt it more than men did, which was very interesting to us. The second thing that we found through the survey, which is on the next slide, was that we believe that clients thought when they retired they were going to do less. They were going to stay at home, possibly less travel. But what we found was that 83% of all the savers want to maintain that same lifestyle. So to us, that screamed out, clients are not going to be doing less in their retirement. They're actually going to be doing as much, and in some cases, they're going to be doing more because they have more time and they need an income for that lifestyle.
And we're actually finding that with some of our existing clients who are retired. They're finding that they're doing a lot more, specifically when they're young retirees, right? And I know that the school of thought has been, plan to have 60 or 70% of your current income in retirement, because theoretically you shouldn't have a mortgage when you retire, and that typically represents 30% of your income. However, we're finding that people are still maintaining mortgages in retirement.
Absolutely.
So we typically project to 100%. Yeah. We'd rather project to 100%, and if we achieve 90%, I think that's far better than projecting to 60% and maybe hitting 65.
Yeah,
right?
Exactly.
So I think based on the survey, it is fairly accurate, right?
Yeah. I always relate things back to my family and my dad. He's about to get into retirement, and at this point he's more active. He's doing more sports. They're traveling more, and a little jealous that they doing it now and they didn't do it with me when I was a kid, but they haven't stopped. And that's why I believe that 83% or even more are going to need that income to progress through their lifestyle.
Yeah, well, the reality of it is that 65 today isn't what 65 was 20 years ago.
Exactly.
Right? People are living longer. They are living healthier. They are they are more active when they're retired. And they need the funds to be able to support that lifestyle, right? So, yeah, great point. Whoops. Let me go back one. There we go.
And the reason why we found this very interesting is, as much as they want to do more or continue their lifestyle, they want it to be simple. We all know that the day-to-day hectic life of work, kids, mortgages, everything that builds up while we're building our nest egg creates complications. So clients are looking for things that are simple. And when we take these three ideas, the simplicity, the reduction in volatility, and the lifestyle continuing the way that they are now, the Helios2 Desjardins product, the guaranteed withdrawal lifetime benefit plan, fits nicely, and we'll talk about it more in the next slides.
Right, and really they don't want to complicate with trying to make decisions with their investments when they are retired. They don't want to try to predict when the market's going to do well, when the markets aren't going to do so well, trying to avoid some of the volatility that I think we've really started to deal with since about 2007, 2008, right? Markets have changed in terms of how they react to information, which is very different than what it used to do prior to that.
And interest rates play a big role in it as well. And you're going to see in the next slides, when I talk about this product, I basically tell our clients, I don't have the benefit of a pension. Most likely 90% of people don't have the benefit of a pension. This is a way of taking your savings and making your own pension, pensionalizing your savings. So that's what people can relate it to. If someone's asking, what does this product do? This product takes your savings and creates your own personal pension.
Right, so I guess it's similar to, I know with a lot of people, they wish that they'd have it, what's referred to as a defined benefit pension plan. So what that really means is, you know exactly what your income is going to be at retirement, and it's guaranteed by the pension company.
Exactly.
So for individuals who don't have a pension plan, there is a way using this product to essentially create their own individual defined benefit pension plan, which a lot of large corporations are actually starting to get away from, right?
You know what, the overhead cost is extremely high. Right. And like I said, I don't have, none of my friends and none of probably your friends have the benefit of having the defined benefit pension. Defined contributions are the new way of retirement savings. So this is a way of getting that defined benefit.
Right. And this defined contribution basically is, what's going in, but you ultimately don't know what you're going to be getting in return, right?
Exactly.
Okay, perfect.
So as Jim said, this is called the guaranteed lifetime benefit, lifetime withdrawal benefit. And basically what it does is it takes your savings and it creates a pension for you. The 75-100, what it means is there's 75% protection on the contract maturity. And the contract maturity is the age of 105. So once you get to 105, we will guarantee that you get 75% of the contract. Now, that is not the key point to this product. The key point to this product is the 100% protection on the annuitant's death and then the income portion. So basically what we're saying is you as the annuitant, the person holding the contract, is guaranteed to get 100% if you were to pass away of whatever you put into the contract. That is if there's no market growth, but if there is market growth, then we give you the market growth. The guaranteed lifetime withdrawal benefit portion allows you to know your monthly income for the rest of your life. And Jim can help you with this if you are interested. We do have great illustration products that we can show the illustrations. But basically what we're saying is you will know what you're getting on a monthly basis for the rest of your life. And you are able to do it on your own life, or you can do it on a joint life. So you and your spouse. That's able to do that as well, and we'll see that on the next slides. But the key to this is with market growth, your income can actually increase, and we'll see that as well. So we'll go through the next slide.
Well, actually, let's talk about the 100% protection as an example, because I think that's very important, specifically for a retiree who, if you look back to 2007, 2008, major market correction.
Absolutely.
People who were retired didn't have the ability to go back to work to make up some of those losses. A lot of those investors had to wait 5 years to break even from that event. So if I look at this, let's use a $100,000 investment, right? So a client invests $100,000 into this contract prior to the market correction, as an example. In 2007, 2008, if they were in a mutual fund, didn't have this guarantee, and they were about to retire, and their spouse passes away, the $100,000 would have been approximately $65,000 in value.
Absolutely.
Right? So $65,000. So prior to that, they were going to take a percentage of $100,000 to live off of, right, based on RIF minimums. But at that time, they were now going to take 7% of $65,000.
Exactly.
Which, I'm not a math guy, but I know it's
much less, yes.
Right? But in addition to that, what I think people were doing is, because they couldn't live on 35% less income, they were then taking a little more risk, right? And it kind of created a bit of a vicious cycle.
Exactly.
Right?
Yeah.
So in this scenario, if we go back to 2007, an investor put in $100,000, the market corrected by 65, the annuitant or the person who owned the contract passed away, Desjardins would have paid out the $100,000.
And one thing that we might have forgotten to mention is this is an insurance contract, so you can,
but not an life insurance policy.
Yes,
people misunderstand.
Exactly. So it falls under the insurance umbrella, which allows us to put a beneficiary to it.
Right.
And the important part of the beneficiary, as many of your clients know, and as you know, is you bypass probate.
Right.
And Desjardins has a commitment to anybody that's investing in our products to expedite the probate to 5 business days. That's on the average is 5 business days.
Right.
So your client, the heartache of losing a spouse and the issues that go with that, at least they know with this, there's the beneficiary and they can come to you and everything moves much more smoother than it would something that has to go through probate with the cost and the time. And sometimes, as you know, when you go through probate, you got to go to the courts and so on and so forth. But because this isn't an insurance, under the insurance umbrella, we put a beneficiary and it nicely goes through to the spouse.
And you're specifically referring Sorry about that. Again, we're dealing with some technical difficulties here. So at least the content is up. I hope people can still hear us. They should be able to. And let's share the video again. Make active video. Okay. So we will continue on. So for GIC investors, again, on a even registered, they're walking into 5-year GICs. They're non-cashable. They're trying to get the best rate of return. They want to preserve their capital. In working with banks in the past, I've seen estates take as long as 2 to 3 years to settle.
Yes.
Because those non-cashable GICs are very difficult to cash.
Absolutely,
right?
Absolutely. And just going back to it, the loss of a spouse is the hardest portion. Getting the income afterwards should not be as difficult. And as Desjardins is been around since the 1900s, the whole principle of Desjardins is to make things easier for the client to hit their financial goals. And this is another way of us doing that.
Okay, perfect. So we can move on to the next slide now.
So this next slide is just a recap. And basically what we want clients to know and when they're getting into this contract is your income is guaranteed for your entire life. And that is the most key and the most important portion of it. What we talk about also is there's protection against the down markets, but what if markets go up? And we want to make sure that you can participate in that as well. So what we have is what we call resets. And every 3 years, we look at the contract, and if the market value is more than the initial deposit, then we reset it. And
so you're locking in the gain.
Exactly.
Okay.
And then you ask, well, what good is that? Well, when you're resetting a larger base, then your income will be more.
Right.
So what we're trying to do is provide as much income as possible when you retire. And bonuses is something that is extremely beneficial. Right now, if you were to open up a contract, we have a promotional bonus of 5%. And basically what that says is, if you don't take any withdrawals in the year that you purchased it, then we will give you a notional 5% bonus. So that helps also in terms of your long-term income.
Just to clarify,
Yep.
That's not a 5% rate of return.
No, it's not a rate of return.
It only applies if you take the funds as income down
Absolutely,
the road.
absolutely. So if you have 100,000 and you put it in today, we will give you 5% for this year, and then you start taking it next year, then you're taking a base of 105,000, but your actual value is 100,000.
And that 5% is not prorated?
It is not prorated. So the beauty about that is December 20th is technically the last business day. So if you were to purchase something on December 20th, you would still get the 5% if you kept it till December 31st. So that's always beneficial as well, and it helps with the overall income.
Okay, that's great.
Yeah.
And the bonuses would range from 2.5 to a cap of 8%.
Exactly, and we'll get into the bonus structure into I believe the next slide or the slide after. But this is where what they say, the rubber hits the road.
Right.
In terms of how much are we going to pay, it also depends on the age that you take. So in the examples that you'll see in the next slides, we use age 65, and that's what I'll use here. So what we're saying here is, between age 65 and 69, as one person, the annuitant, if they're one annuitant, we will pay out 4.1% on a yearly basis. So if that's 100,000, then that's 4,100 done on a yearly basis. You can take it monthly or yearly, whatever you want. But once again, you know exactly what you're getting, so you can plan for your retirement.
Great. And that's based on, again, not on market value, it's based on the guarantee.
The guaranteed, and we call it the guaranteed protected value.
Right.
So that's the market value plus any of the bonuses that have occurred if you never took any withdrawals throughout the contract.
Okay. And then is there an advantage or disadvantage or benefit to go from a two annuitant to a one annuitant? Like
You know what? There is no.
The disadvantage from an income perspective because it's a lower percentage.
It's a lower percentage. The advantage is that if one of the annuitants passes away, then it continues to the next.
Okay.
So in that sense, it creates a much easier flow of capital. But if it's registered assets, you have to make sure. You wouldn't be able to do it on both annuitants.
Right.
This is beneficial for non-registered.
Right. Okay.
Yeah.
I just had a thought. Maybe it'll come back to me afterwards. In terms of the income. Oh, sorry. I'll go back to my thought because it just came to me. So basically, a client could look at this, and let's say they're between the ages of 65 to 69. Mm-hmm. So potentially they would look at it as a joint non-registered contract where they're guaranteed 3.6%, or we could do two individual contracts.
Absolutely.
Right?
Absolutely.
And they'll each get the 4.1%.
Exactly.
And then they can name each other as beneficiaries.
Absolutely.
And receive the funds.
Yeah.
So that's
there is a lot of flexibility.
Right.
And that's what we're also trying to do. We're trying to give you as much flexibility as possible.
Right.
But what you said would work as well. Two people doing two separate contracts.
Yeah.
And then each beneficiary or each person is the beneficiary on each one.
Of each contract. Yeah. Okay. And then just quickly from a non-registered perspective and the income that gets paid out, I don't know if we talk about this later on in the slides. Any preferential tax treatment on that income?
It's return of capital. The majority of it is return of capital.
So majority we're kind of shooting for 90.
Yeah, exactly.
Okay.
And for investors that don't know what that means, that basically means that we start off by giving you the money that you've already invested.
Right.
And by doing that, there is no tax implication.
Right.
And the reason why we do that is because we believe that later in your years, the older you get, the less income you actually are going to be getting, therefore the lower tax bracket that you're in.
Right.
So if you start taking income at 55, you could possibly still be working part-time or leisurely, and that's considered income, so your income bracket would go up more than if you started at 75.
Right.
So that's why we use the return of capital portion of it, and then when you start taking out the actual gains, then there's capital gains and interest, and as you know, capital gains is more favorable. So there is tax advantages in that way.
Right. So if they were drawing $10,000 a year, about $9,000 approximately would be treated as return of capital.
Exactly.
So tax-free, and they'd have to pay tax on the $1,000.
Yeah.
Right.
And we send out the T4s that will tell them exactly what they need to allocate to their tax returns.
So then if they were in an RSP, just to kind of let people be aware of this, if they took up the same $10,000 a year out of an RSP contract, that full $10,000 would be taxable.
Absolutely, right? Absolutely, because now you're withdrawing a portion of gains, you're withdrawing, and then those gains, it could be interest, it could be capital gains. There is a greater tax advantage in this than there would be just doing what we call a systematic withdrawals plan.
Okay, and what I'm kind of finding today now, because of our hot real estate market, a lot of my clients who are approaching retirement, they're taking advantage of the wealth that they've built in the principal residence, and they're selling their homes, they're netting away after purchasing a new place, or some of them are actually renting, and we're taking that money and we're putting it into these contracts, right, and guaranteeing them their pension for the rest of their lives, bypassing probate, because if they kept those homes and they pass away, well, that home becomes part of the estate.
Absolutely.
Right? So we deal with the estate problem. We guarantee their income. Some of them are at a higher tax bracket and don't want that OAS clawback, right, old age security. So to give them 90% of tax-free income, that it's not non-taxable, so there is no clawback, right?
Exactly.
It's a win-win-win situation for our clients, right?
Yeah, and every situation, and you know this, every situation is unique and different. And I always say, you know, your advisor is the guru of these situations. So every client's going to come with a different situation, and it's best to look at it. But the advantages on a contract like this, like Jim said, is bypassing probate, having the pension types income. Like I said, I don't have a pension. My dad's a teacher, so he has the benefit of having a pension and knowing exactly what he's getting. So when someone sells their biggest asset, which is usually their house, they want to make sure that going forward, they can take advantage of that, those gains.
Yeah.
So this is a way of guaranteeing exactly what to expect.
Perfect. All right, so on to the next slide.
So this slide goes into the bonus. And like I said earlier, if you open up a contract this year, we have a promotional bonus of 5%. Every year after that, with no withdrawals, we are going to give a bonus as well. And it's based on the Canadian 10-year bond. That point should say 1.5. So basically what we're doing is we're taking, at the end of November of every year, we look at what the Canadian bond is returning. Then we add 1.5 to it, and that is the bonus that we give to the contract if there's no withdrawals. The minimum bonus is 2.5%. So if for some reason the 10-year Canadian bond is only giving you 0.5, and then you add the 1.5 and it only equals 2, we bump it up to 2.5. The max that we will give is 8%.
Right.
So that is the band that you saw in the first couple of slides of the 2.5 to the 8% in terms of the bonus. And once again, this is a way of building up a foundation of notional value for your retirement. So if clients are buying it say at 55 and they're not going to retire until 65, that's 10 years of bonuses that they're going to be getting. And we see a lot of times that the notional value is larger than the market value. And we take the guaranteed protection value, which is the notional value, as the base for their income.
Perfect.
Once again, we don't have to go over the slide, but this year it's 5%. And then, as I explained in the last slide, the years afterwards, it's 1.5 plus the 10-year.
Perfect.
So this slide, to me, it may seem confusing, but it's extremely simple to understand. How will this product work in a down market? And that is probably the biggest question I get. People, think of the tech bubble, the financial crash, even in 2015 with the issues that we have with the oil. The Canadian markets were not as robust as they were in previous years. So how does this contract work in a down market? So what we've done here is we showed an investment of $100,000, and the client is 65 years old, so that means that they'll be getting 4.1%, which is $4,100 a year. The red line that goes downwards is the market value of the portfolio. So we're suggesting that there is terrible markets, the market value is decreasing. But the blue line, those blue solid lines, shows your income. And as you can see, it never changes. And that is the benefit. Regardless of the market, you're going to get that exact amount of 4,100. The great part of it is, if you look at age 83, I believe, it shows that the market value is zero. Even with the market value at zero, you're still getting your $4,100 because you're still alive, and this is a guaranteed lifetime income product. So this is a great slide to show what happens to your contract, to your money, and to your income if we have a downward market.
So it performs better from an income perspective comparable to a GIC.
Absolutely.
So if someone's in a $100,000 GIC and they're relying on the income and they're earning, let's say, 2% right now, $2,000 of fully taxable income, so they're probably netting out, let's call it $1,500, right? It's not a lot of money.
No.
In this scenario, we can get them $4,100, and the bulk of that is tax-free.
Absolutely.
Or tax-deferred. Right? It's not tax-free, it's tax-deferred. So at some point, there will be a gain to be paid.
Exactly.
That's at the estate level, typically, right? This definitely outperforms GICs right now from an income perspective.
And that's what in every one of these types of investment strategies, there's a benefit. And the benefit for this is to make sure that you know what you're getting in terms of income. GIC clients, they like the security. We provide that security. But now we're also providing the income that the GICs typically do not provide. And we also help with the estate probate also.
And even on the upside, let's talk about that.
Absolutely.
People who like mutual funds, people who like being in the stock and bond portfolio, people who like investing with the banks and they're going to offer them GIC and mutual funds. So in this scenario, you're in a mutual fund, and I don't think realistically we're going to see a negative 2% per year. I think that's what we're projecting here. We're just kind of showing the power of the contract.
Exactly.
But we did see a negative 35%.
Absolutely.
Right? And we have seen, last year we've seen negative, or 2 years ago we've seen negative numbers. So there's a lot of volatility. That if we go back to one of the first slides we talked about is, we just want to simplify things.
And that's what it does.
And that's what this does. So a client can make a better return, right, and enjoy the upside, but also protect themselves.
And that's the next slide, actually, as you
were talking about. There you go.
So, once again, this is to protect your income, and so showing you how it reacts with down markets is more powerful because people are more concerned. Once again, going back to my parents could they love making money, but do not lose them a penny. And once again, when we look at a slide like this, what happens if we have really good markets? If you remember from the previous slide, we do a reset every 3 years. So we'll start off again at 100,000. The client is still 65 years old, and they're getting $4,100. Now, we then go, and the market value, which is the red line, is increasing. And so what happens to the contract? And what happens to the contract at that point, every 3 years we look at it, and you can see that the blue bars are increasing. So after the third year, so the fourth blue bar, it's a little bit higher. So it's 4.1% of a new guaranteed market value. Okay. And then what can also happen is, because the client is 65, and let's say there's a 6-year upward market, and then we've done 2 resets. Now the client enters a different income, the 71-year-old income bracket. So now you're getting the benefit of having a higher market value, and the benefit of having a higher payout. So when you look at the slide, now the client is getting 4.6% of the new value of the market, because then we reset both. So the blue bars are increasing because the market is increasing, and that is done on a 3-year term. And then the market starts taking a dip, but then the blue slides stay the same. So we increase the income, and then if markets start going the downwards, the income stays the same. So you will never get less than you've had when you started it. There's always the potential of more.
And basically, in order for clients to benefit this type of growth, would it be fair to suggest that if the market value would have to outperform the bonus base for this to really work?
Absolutely. Absolutely.
So if we don't see the bump up, it basically means that the investment performance has lagged behind the guaranteed bonus.
Exactly.
But if we're outperforming it, then we're seeing these resets.
And like you were saying about mutual fund clients, at Desjardins, we believe that we can leverage other great investors, like your Fidelities or your CIs. So when your clients come in looking for an investment option, we have those available to them. So you get the feel of the mutual fund, because we are purchasing mutual funds within this life contract, but you get the benefit of the insurance foundation, insurance umbrella. So the market growth is typically the same, minus the fees of the mutual funds that people know and appreciate and understand.
And basically this kind of follows Warren Buffett's rule of investing, right? Rule number 1, don't lose your money. Rule number 2, don't forget rule number 1, right?
Exactly.
So it's very similar to that, right? All right. So basically this is a scenario, right?
And everybody, those that are listening, those that are viewing are probably wondering, does this fit for me? Am I the right candidate? And the first thing I would say is talk to Jim. Jim knows many different scenarios, but the one scenario I did want to bring up is this one. And basically, this is somebody 58 years of age, and she is in the private sector. And as we know, in the private sector, there is no defined benefit, like we were saying. So she doesn't know what she's going to be getting. The money that she has built up, she's worked very hard for. So she wants to make sure that she can continue her retirement the way that she wants to, and this once again allows that. She takes whatever the value of her portfolio is, applies it to the GLWB, and we know exactly for the rest of her life what she will be getting in terms of an income. Once again, she's building her own personal pension plan. And for clients that are in that age group looking to retire and are about to retire, this is a great product, because if you're 58 looking to retire at 65, that's 7 years of bonuses. And the bigger the foundation, the more of the income. So a great tool. One of the scenarios that is not on here is business owners as well. Business owners there's creditor protection with these products. So business owners are investing their hard-earned capital into this, so that when they do retire, it's there and it's protected from outside sources.
That's a very important point. So basically, if we kind of look at this opportunity or this type of contract, if you're in the accumulation stage, don't want to take a lot of risk, you want to have an understanding of what your income will be guaranteed at 10, 15, 20 years down the road, ideal product. For people who are close to retirement, again, who are liquidating some assets, and want to, I guess, pensionify their funds, right? This is a way of doing it. And for clients who are currently in RIFs, right? I mean, I think the benefit to this, and I've seen it with a lot of my clients who have turned on the income in these contracts, is they do get a point where the guarantee amount is actually higher than what the RIF minimum requirement is. Right.
And we and let's say it's the opposite. Let's say the RIF minimum is higher than the guaranteed amount.
Right.
We will pay out the RIF minimum.
Right.
And there's no penalty.
It
doesn't affect the contract at all.
Right.
The RIF minimum needs to be paid because that's the law.
Right.
And so we follow that.
Right.
And the one thing that we were talking about prior to starting the broadcast was this is a portion of your financial security.
Right.
This doesn't need to be all of it. It can be all of it if you feel comfortable and you want that security, but this is a portion. You know, you have your mutual funds, you have your stocks, you have, if you want, your own personal bonds, but this is a portion, and this portion becomes the foundation of your retirement income. And then everything else is what they say, the cherry on the sundae.
Right.
But at least you know what the foundation is.
I basically kind of explained this to clients. It's really a set it and forget it type of solution.
Absolutely.
There isn't really a requirement to review what's happening because you're getting that guaranteed bonus no matter what, right? So it is very boring and slow and steady. Where people don't maybe appreciate this contract as much is when the markets are going really, really well.
Absolutely.
And we don't capitalize on that growth. But I'll tell you, people really appreciate this contract is when the markets are in negative territory and they still have that guaranteed base. They don't have to worry about it, right? So you can basically rest at night, and not to suggest that all the person's assets should go into this contract. But for sure, to be able to put a portion of it, like you said, as a foundation, and if everything else works out well, that's wonderful. If everything else doesn't work out well, there's a backup. At least they have that backup, right? So I think that's very important for people to understand. And I think the one thing we haven't touched on really is this money isn't really locked in, right? So there is liquidity in there, so there is market value. So in the event a client needs some funds or some cash available, there's a 12% of the value, I believe, is you can take out without penalty, correct? And that'll affect some of the future bonuses.
So what happens is if you do take out more than the requirement, then there's an adjustment.
Right.
So at one point you're getting $4,100 a month, and for whatever reason, because life happens, you need to take out more, there's an adjustment made. And that's something that we can calculate and you can help your clients with. But just going back to what you were saying and actually bringing up Warren Buffett, one of his sayings is, I invest in something and then I go to sleep for 5 years and I look at it again. Right. And this is what we want to do. We've done the work behind the scenes to make sure that the investment options are going to protect you and they're going to be able to provide you with that income the best that we can without knowing what the markets are doing. But like you said, it's a set it and forget it, and it's the foundation of people's retirements.
Yeah, for sure. Well, I think we did a pretty good job of explaining the contracts. We don't have any questions right now. So if you do have any questions after the fact, you can reach out to me by way of email, jim@tvhgroup.ca. If you'd like to schedule an appointment to explore this a little further on a one-to-one basis, you can email Carol at financial@tvhgroup.ca to schedule an appointment. Or you can give us a call at 647-727-4668. I want to thank David for joining us today, for going through the presentation. And everybody have yourselves a good night.